How banks earn from the stock market in India, the hidden truth. Banks in India play a significant role in the stock market ecosystem, acting not just as facilitators, but also as active participants in the trading and investment landscape. While their direct and indirect revenue streams are generally well known, some mechanisms by which banks profit from the stock market remain less obvious or hidden. These earnings stem from services provided to retail and institutional investors, leveraging their own investments and utilizing regulatory frameworks to their advantage. Below is an in-depth exploration of the visible and less visible ways Indian banks earn from the stock market. 1. Brokerage and trading services. Most large Indian banks operate brokerage arms, offering retail and institutional investors platforms to trade stocks, derivatives, mutual funds, and other financial instruments. Demat and trading accounts. Banks charge fees for opening and maintaining demat and trading accounts. While the charges are relatively small, the volume of accounts generates significant revenue. Brokerage fees. For every trade executed by their clients, banks earn a commission. These fees can vary depending on the trading volume and type of asset, e.g., equities, derivatives. Hidden charges. Many investors overlook small fees like annual maintenance charges, AMCs, transaction charges, and margin interest, which cumulatively contribute significantly to a bank's revenue. 2. Proprietary trading. Proprietary trading, prop trading, is when banks invest their own capital in the stock market. This activity allows banks to generate profits directly from market movements. Equity and derivative trading. Banks often participate in the stock and derivatives markets, taking calculated risks to earn profits. Arbitrage opportunities. Banks exploit price differences between different markets, e.g., equity and futures markets, to earn risk-free profits. Algorithmic trading. Using sophisticated algorithms, banks execute high-frequency trades to capitalize on minute price movements, often unnoticed by retail investors. 3. Investment banking services. Indian banks with investment banking divisions earn substantial fees by facilitating corporate activities such as initial public offerings, IPOs, mergers and acquisitions, M&A, and debt issuances. IPO management. Banks act as underwriters or lead managers for IPOs, earning fees for helping companies raise capital from the stock market. Advisory services. Banks charge corporations hefty fees for strategic advice on mergers, acquisitions, and divestitures, all of which indirectly impact the stock market. Private placements. Assisting companies in raising funds privately through high-net-worth individuals, HNIs, or institutional investors is another lucrative avenue. 4. Margin funding and loans. Against shares. Banks earn from the stock market by providing loans against shares and margin funding to traders and investors. Margin funding. Banks provide funds to clients to trade in the stock market by leveraging their existing holdings. They charge high interest rates, which serve as a stable revenue stream. Loans against shares, LAS. Investors can pledge their shares as collateral to secure loans. While this service is marketed as a liquidity solution, banks earn interest and can even sell the pledged shares if the borrower defaults. 5. Mutual funds and wealth management banks often distribute mutual funds and offer wealth management services, earning substantial commissions and fees in the process. Mutual fund distribution. Banks earn upfront commissions and trail fees for selling mutual funds to retail investors. This revenue stream thrives on the trust customers place in their banks. Portfolio management services, PMS. Catering to high-net-worth individuals, banks manage personalized portfolios and charge management fees, a percentage of the portfolio's value, and even performance-based fees. Hidden costs. Many investors are unaware of the expense ratios and other embedded fees in mutual fund products distributed by banks. 6. Custodial and clearing services. Banks provide custodial and clearing services to institutional investors, including foreign portfolio investors, FPIs, earning fees for these specialized services. Custodial services. Banks act as custodians for institutional investors, holding their securities in demat accounts and earning annual or transaction-based fees. Clearing services. Banks play a critical role in the settlement of trades, earning clearing fees for facilitating these transactions. 7. Market making and liquidity provision. Some banks act as market makers for specific stocks or financial instruments, ensuring liquidity in the market. Spread earnings. By quoting buy and sell prices, banks earn the bid-ask spread on transactions. Exchange incentives. Stock exchanges sometimes incentivize market makers to maintain liquidity, providing an additional revenue source for banks. 8. Treasury operations. Banks invest in equity, bonds, and other financial instruments through their treasury operations. Investment portfolios. Banks hold substantial equity and debt investments in their treasury books, earning returns from capital appreciation and dividends. Trading profits. Active trading in equity and bond markets allows banks to capitalize on short-term market fluctuations. 9. Structured products and derivatives. Banks design and sell structured financial products, including equity-linked notes and derivatives, to clients ranging from retail investors to corporations. Custom products. These products often combine equity and derivatives, providing exposure to the stock market with tailored risk-return profiles. Derivative hedging. Banks use their market expertise to earn from derivatives while managing their own risk. 10. Regulatory arbitrage. Banks occasionally take advantage of regulatory loopholes or inconsistencies to maximize profits. Capital allocation. By channeling funds into high-return equity or derivative markets instead of traditional lending, banks optimize their risk-adjusted returns. Relationship with regulatory authorities. Banks' influence and understanding of the regulatory environment allow them to navigate compliance requirements while pursuing market-linked opportunities. 11. Insider knowledge and influence. While not explicitly illegal, banks sometimes benefit from their insider knowledge of market dynamics. IPO allocation. Banks involved in IPO underwriting have early access to pricing and demand trends, which can inform their proprietary trading decisions. Market sentiment analysis. Banks leverage their access to vast customer transaction data to gauge market sentiment and position themselves advantageously. 12. Hidden risks and criticisms. While banks profit significantly from the stock market, their activities are not without risks and ethical concerns. Conflict of interest. Banks that simultaneously manage client funds, provide advisory services, and engage in proprietary trading may face conflicts of interest. Risk to clients. Products like margin funding and structured investments often carry high risk, which is not always disclosed transparently to retail clients. Market manipulation. There have been instances globally where banks were accused of manipulating markets to benefit their trading books. Not conclusion. Banks in India earn from the stock market through a combination of visible and hidden strategies, including brokerage services, proprietary trading, IPO,